This week, I want to talk about the increasing expenses in producing a mortgage and come at it from a little different perspective than is normally discussed. Within the past week or so, there was a big Freddie Mac study showing the cost on average to produce a mortgage, how it ranged from lower cost, some below $6,000, some up as high as $17,000, and all the traditional ways that people look at trying to keep those costs under control. But one factor that has never been in the study, which I'm going to go into today, is the cost when an originator begins a mortgage and it dies in underwriting due to the loan officer's fault. Not only the loan officer's fault, but everybody at the loan officer's company that either should be training the loan officer or where the mistake should be caught up front at the loan officer assistant or processor level, and finding the problem before it gets all the way to underwriting, which is when the loan is normally denied and it's so close to closing that it causes a lot of grief and these expenses that I'm going to go into you with. So when this happens, not only does the mortgage company lose all the hard costs, the credit reports, the VOIE, if there was a condominium questionnaire, those are tending to run $400 or $500 if you use an outside company, between what the company charges and the HOA charges. Then I know most companies get the appraisal paid up front, but not all of them do. So depending on the circumstance, you could be looking at over $1,000 in hard costs. Then you have the cost of the labor, anybody who's being paid salary from the LOA to the processor, and then all the way up through the underwriter. And companies are aware of these costs, but they're never broken out. However, there are additional costs today that I want to go over. The first is most people have a level of income that they expect to make, that they're comfortable making. And so let's say we have a loan officer that closes 3 loans a month, $500,000 each. They're producing $1.5 million in volume. They could be working for 100 basis points, 1% of the loan amount if they're in retail. I understand in the broker world, a lot of times there's a higher commission, but then in the broker world, they're typically paying for a lot more of the expenses out of their pocket. So let's say the average net compensation before taxes for a loan officer is 100 basis points. And so that loan officer on $1.5 million in volume, we're looking at $15,000 a month for the income. And that's a good income, and a lot of folks are very happy with that. The problem when one of those loans dies in underwriting is that the loan officer may have sort of stopped their prospecting for that month. I know some people prospect continuously and they want to grow more, but in the real world, we do see people have other obligations. And a lot of loan officers, they've got their 3 loans, they think it's going to close, they've got their $15,000. So if they found out up front, even though they might have thought that the loan would close, if they found out in the first day or two after originating the loan that there's a problem with it, they then could have gone out and kept hunting. Instead of taking the next Sunday off, they might have gone and hit the open houses or reached out to even more realtor potential partners or folks that they've worked with in the past, et cetera, to try to replace that loan. So far now, we've not only lost all the money that was spent on the loan that didn't close, but the loan officer and their company are now a loan short. Now, continuing on, it is a very stressful event for anyone when that loan dies in underwriting 3, 4, 5 days, a week before closing. There's very few people that won't feel that stress. How to break it to the customer, the realtor partners potentially. There may be 2, 3 days of fighting internally to try to see if there's any way to restructure the loan or save the loan. And then when it can't be done, oftentimes that stress is and the time involved in watching and trying to save that loan is now going to hurt them for the following month. So time when maybe they'd be knowing that their loans are all set to close and they'd be starting hunting and looking for the next month's loan is affected. So you could easily have the next month with one loan short. So not only is the loan officer, did they lose one loan from the present month, they lost one loan from the next month. That's $10,000 in their pocket. And the company lost the revenue from two loans that would have been made if the problem was found out up front. Now, when we add in all the lack of repeat and referral business, so it's that customer not coming back, that customer telling everyone they know, don't use this loan officer, don't use ABC Mortgage Company, or certainly don't use this branch of ABC Mortgage Company, as well as the realtor partner having that attitude and telling all their cohorts how a company blew up a loan. You've got then all the social media posting. Today, people with hundreds or thousands of followers may be going online and broadcasting that they went to a particular company and the company messed up, and now they're in a very difficult position with their loan not closing. You also have, while it's an outside risk, you could have a fair lending complaint, because fair lending attorneys tell me fair lending complaints are always initiated when a borrower has been promised something they don't get. You've got someone who has been subject to discrimination in the past, and they don't understand why they're being told, yes, you're all set, your loan's going to close, and then a few days before closing, some story comes up. So naturally to them, it feels like discrimination. And those are very expensive and aggravating situations for any loan officer or company to find themselves in. Now, I do have a program to help newer loan officers avoid this type of mortgage fallout. The program is the THEComplete1003.com, or you can email me, Alan, ALAN, at thecomplete1003.com. I'm going to give you one example of a loan that blew up this past week. It was posted online. Unfortunately, I do know that this newer loan officer had at one point contacted us about some training, decided not to get it. And the situation they found themselves in the week before closing was that their borrower had sold a property, which they call the subject to. So the buyer didn't pay off the underlying mortgage. The buyer got title to the property, left the existing mortgage. Yes, there's a risk that the lender could have called it. They don't always get called. So people take a chance. They transfer title. The loan remains. And this loan officer, because someone else had been paying it had been paid on time, thought that because that had been going on for over a year, that they could eliminate that mortgage payment from their borrower's debt-to-income ratio. Now, if anybody was watching this person closely, or didn't have to watch closely, anyone with experience would know that unless the person was obligated on the mortgage, it was not possible to eliminate it from the debt-to-income ratio. And in a subject-to transaction, the person has not become obligated. They haven't assumed the mortgage. They haven't gotten a new mortgage. They're leaving the old one in place. Now, I did come in. In some cases, there is a way possibly to get the mortgage not excluded, but to offset the mortgage payment with note receivable income, depending on what was put on the tax returns, depending on what the borrower's CPA may write in terms of a letter as to why it isn't on the tax returns if they decided not to put it. But here's a case where someone didn't want to make the effort to get some training. Their company didn't want to make the effort to get them some training. The person is clearly not being watched, because to someone who's experienced, this is a rookie mistake. Anyone with experience would have immediately noticed that, wait a minute, the person who bought it subject to was not on the mortgage, And even though they've been paying it for over 12 months, it can't be excluded. So think about the long-term cost, whether you're an individual loan officer to your own little business that you run as an individual, that you're the CEO of your own business, or if you're a branch manager or you're higher up in terms of management, all the way up to the C-level. Think about what the long-term enterprise value damage and cost is to your company when these loans are submitted and die in underwriting. And if you'd like to chat about how I might be able to help you minimize it, if not eliminate that problem, you know how to get in touch with me.